All right, today we're going to tackle a topic that people seem to either love or find completely confusing: technical analysis. We're going to dive into how those squiggly lines you see on a stock chart might actually be telling a really powerful story about human psychology.
So let's just start with the big question, the one every single investor faces. When you look at a stock chart, what do you see? Is it just pure, unpredictable chaos, random noise? Or could there be patterns hiding in there? A kind of language that the market is speaking? That's the puzzle we're going to try and solve.
And that question, that whole idea of randomness, is the perfect starting point. So section 1, is the market truly random?
You know, there's a huge school of thought that says markets are efficient, that all the news is instantly priced in, which makes trying to predict the future pretty much a fool's errand. But what if that whole theory is looking in the wrong place? What if the real clues aren't buried in a company's balance sheet, but are hiding in plain sight, in the collective behavior of all of us?
Okay, so if the clue isn't in the financials, where is it? Well, that brings us to the answer that technicians propose. It's a method for trying to find some order in all that chaos, a way of, well, listening to what the price is actually telling us.
So how does this all work?
Well, you have to understand that there are really two main camps here. On one side, you've got fundamental analysis. This is kind of like being an investigative journalist for a company. You're digging into its earnings, its sales, its management, all to figure out what the company is truly worth. But then you have technical analysis. This is more like being a crowd psychologist. You're not really focused on the company itself. You're obsessed with the market's reaction to the company. You're studying price, volume, and the emotional tides of the crowd.
Okay, so this whole approach really boils down to three core beliefs. First, that market action discounts everything. What that means is that any news, good, bad, whatever, is already baked into the price you see on the screen. Second, prices move in trends. You know, an object in motion tends to stay in motion. Technicians believe the same is true for a stock price. And third, and this is the one that really ties it all together, history repeats itself.
So why on earth would history repeat itself in the market? Well, it's simple, really. It's because the engine driving everything is human psychology. And human psychology hasn't changed all that much. The emotions of fear and greed trigger really predictable reactions, like panic selling or fear of missing out. And those reactions create patterns on a chart. The shape of a buying frenzy, literally etched into the price history, looks the same today as it did 100 years ago.
All right, that all sounds great in theory, right? But how does it actually work in practice? Let's look at some of the most basic footprints that technicians follow to try and read that market psychology.
The absolute bedrock of all of this is the idea of support and resistance. Just think of them as floors and ceilings for the price. Support is a price floor where buyers have historically shown up to stop the price from falling further. Resistance is a ceiling where sellers tend to appear and stop a rally in its tracks. But why? Why do these levels even form in the first place?
Well, this quote from the technician John J. Murphy explains the psychology perfectly. Just imagine a stock price bounces hard off a certain level. Instantly, you have four different groups of people all staring at that exact same price. You have the people who bought there and are now feeling smart. You have the people who sold there and are now kicking themselves. You've got the people who wanted to buy but hesitated. And you have the people who were on the sidelines who now see a clear line in the sand. All of them are now thinking the same thing. I'm going to buy if it gets back down there. And that creates this huge wall of potential demand.
And if you want proof of how powerful this collective memory can be, just look at this chart of IBM. This is absolutely wild. The huge bottom the stock made in 1993 happened at almost the exact same price level as a major bottom from 20 years earlier, back in 1974. I mean, that's a psychological footprint that lasted for 2 decades. It shows these levels aren't just random, they're markers of the market's memory.
And, you know, the psychology can get even more basic, even more human than that. It's not always about a specific historical level. Why do stocks so often seem to struggle at nice, clean, round numbers like $50 or $100? It's because we're human. We're drawn to them. We see them as important milestones. So traders place their buy and sell orders there, and that collective belief turns an arbitrary number into a very real psychological barrier.
So when you put all these pieces together, it really gets to the core of what we're talking about, what this whole field is really a study of.
Okay, so after all this talk about psychology and emotion, you might be thinking, isn't this just a fancy way of guessing? Well, Not for the people who do this seriously. For them, the whole point is to remove their own emotion from the equation. And they do that by building a disciplined trading system. It's actually a super rigorous process. You start with an idea, you turn that idea into objective black and white rules, then you test those rules on historical charts to see if they even worked in the past. It's a very deliberate attempt to systematize the reading of market psychology.
And that really brings us full circle, back to this quote from John J. Murphy, which just sums it all up perfectly. At the end of the day, chart analysis isn't some crystal ball for predicting the future, it's really just the study of human psychology, a visual record of how we all react under pressure and uncertainty. Those patterns on the chart, they're just pictures of fear, greed, and hope.